Welcome to the very first LTB webinar. This is the first of a series of free webinars with different business experts, community leaders, and successful entrepreneurs to talk about valuable topics that will help you learn, grow, and lead your business. Today's topic is a great one and just in the right time. This topic is 5 tax moves to make before year end. My guest today is Yosef Klein. Yosef is a senior manager in Roth & Co.'s New York office. He helps business owners with effective tax structures and tax transaction planning. He's a key member of the firm's tax compliance and consulting division. Yosef has nearly 2 decades of experience in assisting clients in tax compliance and reporting. Before I hand over the webinar to Yosef, I want to note that we will aim for a brief Q&A at the end of presentation. So if you have any questions that come up while we're doing this webinar, be sure to enter them in the chat box during the webinar. We'll get to as many questions as we could. Without further ado, hello Yosef, welcome to the LTB webinar.
Good afternoon, Manny. It's a pleasure to speak to you today. And let me start with the title. My goal today is to give the listeners at least 5 tax ideas that they can still implement before year end. And I hope to be successful in this goal. I think the first tip of the day, which is we should start is that you should all take out a pen and write on a piece of paper 1 to 5. And on the first tip, you should write the name of your CPA tax advisor, write down the name and the phone number. In order to start with the actual tax tips, let's move to the next slide. The goal of this seminar is to explain how, even with whatever your business situation is, how much money you earned so far in the first 11.5 months of the year, there still may be opportunities to lower your tax rate on the income that you already earned by properly taking advantage of tax laws and the way the rules work. And
yes.
sometimes...
So Yosef, I think it's important we should start off with the webinar with, first of all, congratulations for everybody that has an issue that they need to defer their taxes. That means they had a successful year. So yes. Baruch Hashem, they're starting off with having a successful year, and now we're looking for ideas how to defer from paying all these taxes. Another important thing I think is worthwhile mentioning before we jump into the actual tactics is those are all conversation pieces which you should have with your tax planner, tax advisor / CPA accountant, where we could take those ideas, and there's so many other ideas, but those are common ideas which you put together where you feel people are not paying enough attention to when it comes to year's end. And a third thing is I think it's important for people to think out of the box when you're seeing something on the sheet, Yosef explaining, think how that pertains to your business. It might not be the exact scenario where he's mentioning, but think out of the box and see how you could take that scenario and how it's going to affect your business and your tax financial goals and so on and so forth.
So to continue and expand on that, I just want to some general tax concepts and either introduce them or quickly review them. One is that the tax rate is the U.S. tax rate, federal tax rate is progressive. It means as you earn more income, each additional dollar is taxed at a higher rate. So for 2015, if you're married, filing jointly, and you have ordinary income, if it's more than $411,500, you're taxed each additional dollar at 35%. And if it's over $439,000, each additional dollar is taxed at 39.6%. So that's why many times we find that it's important to be able to either defer income or increase expenses, let's say 2015, because you don't want to have each additional dollar of income taxed at such a high rate and pushing it over, deferring income to 2016 or later gets you a lower tax bracket. So not only do you have more time to pay your tax bill, you actually end up paying less tax when the tax is owed. In addition, there are some ways to spend money in a tax-efficient manner so you get a deduction or tax deduction in the manner that you can use it instead of not being able to use it at all. And we will further explain some of these ideas as we go along. Go to the topic of what does deferring income to the next year is. For many small business owners who are on the cash basis, taxpayers, which means that they report income on their tax return based on how much cash they earned during the year and expenses on how much they spent this year. There are various opportunities of deferring income to the next year, and it may be some of them. One suggestion which we have is that you just simply don't collect the money. When you call your clients to pay you, you ask them to send the check January 1st. You can still ask them for the money, but by pushing off, instead of getting the check this week, wait 2 weeks for the money, you're giving up use of 2 weeks of the money, but you get the check in the mail on the first week of January. That's when you earn the income. And it's as simple as that. You just need to be careful that once you receive the check in the mail, it's already your income, whether or not you deposit it in the bank. So that is one way to make sure that you have less income in 2015 without giving up significant use of the money, because you're going to get it in 2 weeks.
So Yosef, just to confirm, the listeners understand what you're saying is basically the bottom line. If you are on a cash basis, and that's something, if people on the phone are not familiar, that's something they should speak to their accountant. There are companies that are set up as cash basis, and there are companies that are set up as accrual basis. And the real number one difference is, are you going to be reporting based on when the money came in, or the time of service rendered? And if you did the service this year, so you did a sale, but you did not receive the money, that's what you're referring to as cash basis. That means that ultimately you don't have to show it on this year's income. Is that correct?
Yes.
Okay.
That's one idea which we come across. And just to note, the reason why I'm suggesting this is because from a running your business perspective, we're just picking up the income literally for 2 weeks, getting the use of the money for 2 weeks. So that's not a big cost of the way of doing business for most people, and a big tax savings. Another idea is installment sales. What do we mean by installment sales? Is there are at various times of the business cycle, you're selling either a business or other business assets, and it's capital gain, not ordinary income, not for services or goods sold in the regular course of business. Maybe you're selling the warehouse where your business is located because you're moving to another location. Maybe other types of assets that when you sell them, you're going to have capital gain. And especially if you're looking to close a deal quickly before year end, because that's when you're required to go to closing. Installment sale means that instead of getting all the money at closing, you're going to split up the payment between how much you get at closing, maybe today, tomorrow, or Friday, and how much money you're going to collect at the beginning of January. What this does is, again, you're giving up use of your money. Let's say 10% down payment and 90% in 2 weeks. So you're giving up the use of 90% of your money for 2 weeks. And for tax purposes, you just split the capital gain between 2015, 10% of your total gain in 2015, and 90% in 2016. So what that does, two things. One is, depending on what other income you have during the year, you may end up in a lower tax bracket. And step two, if your income is earned at the beginning of 2016, you file it on your tax return, in an additional 12 plus months from now. So you pushed off paying and reporting the tax, and then you have the additional 12 months to do tax planning and further see how you could actually reduce the actual tax bill on that additional income. Another idea which you have, again, it applies to people who have sold either stock or their businesses for capital gain or other real estate at a capital gain, is to review what other capital assets you have, which means assets that if you sell you'd have gain or loss. And sometimes especially with brokerage accounts or other types of assets, you may have people in business may have assets that are no longer worth anything, but they paid for it, and you're still not selling them because maybe you still hope it's going to turn around. Maybe there's some sentimental attachment to it because you invested so much money. But if from a business perspective, it really doesn't pay to hold on to it because it's never going to turn around. Maybe it's a piece of real estate in the biggest slum neighborhood in the whole area. It is beneficial to sell lost property in the year that you have large capital gains, because that, for tax purposes, the numbers net. If you have capital losses, the loss is going to happen in a year or two when you really have to give up the property and you don't have capital gains. You cannot use the losses against ordinary income, only $3,000 a year on your individual tax return. So another strategy which we come across is trying to time, if you're already stuck with capital gains, maybe installment sale doesn't work anymore, maybe you had the sale of gain property in the beginning of the year, no longer can push it off. Another thing that you can still do is by carefully reviewing what other assets you own, is to sell the lost property or actually to abandon it, to walk away from it. And based on your specific situation, you'll be able to net the gains and the losses and reduce your overall tax bill. An additional, yes, Manny?
Yes. So that's usually netting capital gains and losses is usually related to properties or assets of the company versus services and sales.
That is correct. It's more in the range of either real estate owned or actual business property owned, maybe machinery or equipment that's just outdated but hasn't, but still you still didn't fully depreciate it, and if you have a brokerage account, stocks and bonds.
Got it.
That expense, which you come across is besides for business bad debt expense, like accounts receivable, which is really, it's a little bit, goes back to the, reviewing, just like in the first bullet point we said, you're going to, reduce the collection of actual cash on your money. At the same time, there are people who owe you money and they just haven't been paying and they will not be able to pay you. So a good review of accounts receivable will also show how much actually of the money is collectible. Money that's not collectible from the accounts receivable cycle is a bad debt expense, is a deduction. And that also needs to be, that is a good time at the end of the year to review that carefully to see what you're entitled to. In addition to that, various people, business entrepreneurs and owners at points in time will lend money to people that they have business connections to, but it's not accounts receivable. It's not because you provided services or sold them goods. You lend money to other people who are starting out in a similar business. You lend money to someone maybe who's a business in the same area because you want more business traffic. There's different reasons why a business owner would lend money to people not part of the accounts receivable cycle. And sometimes, hopefully we all want to get paid back when we lend money, but that's not always possible. At some point in time, you're lending money and you're not going to be paid back. A careful review of these, let's call it notes receivable, that you have can show that if you're really not, we can show that you're really not going to get paid back. You can take an extra loss in the current tax year because they're no longer collectible. And for tax purposes, this also means that we have to make sure that you actually demanded the money and put in effort to collect the money. In addition,
Yosef, so this is something very interesting for me myself. I think a lot of people on the phone, this is something new. When you're saying about collectible notes and loans, is that related to you on the personal side, or the money has to come out of the business side? Meaning, say, could I just have a check, a loan that I gave for a person, and I came up with the conclusion this year that it's a bad debt?
so the answer is that the bad debt part has nothing to do with where you wrote the check from. Because if you're definitely not getting paid back, it's an expense. The only difference is if from a tax perspective, is it a business bad debt or a non-business bad debt? Non-business bad debt means that we treat it like a short-term capital loss, which means that if I don't have any other capital gains, it's only $3,000 a year. If I have capital gains, it reduces capital gains, and the highest tax rate for capital gains is 20% or 23.8%, depending on how much money. If it's a business bad debt, it reduces my ordinary income. And if I'm in the highest tax bracket, every dollar of that lost money gives me a tax deduction against 39.6%. So it's a two-step process. First, it's making sure that you're not getting paid back, that you're entitled to the loss under the tax rules. The second step is it a business bad debt or not? So to answer that question is, the IRS calls this a facts and circumstances test. So while you don't have to have the check, the note coming out of your business account, it's definitely better. It's all the more important that the reason why you lent the money to this person who's not paying you back now was for a business reason.
Mm-hmm. And on the note of bad debt expenses, what proof do you need to have in order the IRS should feel that this is a non-collectible debt?
What did you do to collect the money? Did you send them notice and demand letters? Have you been calling? Did you retain an attorney for collection? Did you sue in court or arbitration, otherwise known as BESN? Did you retain an attorney and the attorney did a credit search or some other asset search and he sends you back a letter? Essentially, I can sue this person, but there's no assets to collect from, so it's not worth it to go through a lawsuit. Okay. Those are the things that you need to do. Again, these are general ideas, but there are actual steps that need to be done. And in the year that you determine it's not collectible, that's the year that you take the loss or deduction.
Got it. So let's move on to number 2.
Okay. Again, let's go to the cash basis taxpayers. Carefully review your expenses. You know, you still have bills; they may or may not be due. Again, it's not efficient to pay bills for the next 6 months until December, but you can accelerate your bills that are due in the beginning of the year. Let's say in January, and pay them in December. Maybe you know, and that's how you can increase your deductions for the tax. Another tip that we have is that if you don't have cash in the bank, you can use your credit card. Even if you're a cash basis taxpayer, using your credit card to be able to pay your business expenses, and then of course you have the grace period on the credit card to pay next month, but all your expenses are treated as if you paid them during December. That is a simple and beautiful way to increase your deductions in 2015.
Mm-hmm.
And this applies.
So you're saying that those are expenses from 2015. Without my credit card in the bank, I don't have the money to pay it, so I won't have the deduction. But if I put it on my credit card and the statement is within the year of 2015, the deduction is happening in 2015.
Yes.
Perfect. Wow.
Now, let's just start another idea, which is, again, is not so much increasing your expenses, but spending smartly. Um, Many of us, especially with Obamacare, have health insurance, but even with health insurance, you have various medical expenses, whether it's co-pays on insurance, co-pays for the doctor visit, visits that are medical expenses that are not covered by insurance but need to be paid, and also you're not reimbursed from, let's say, your flexible spending account or health savings account. You have your own out-of-pocket medical expenses. Under the IRS rules, those medical expenses are deductible with what we call itemized deductions. And the first 10% of your medical expenses, 10% of what we call AGI, adjusted gross income, that's the dollar amount at the bottom of page 1 of your tax return, of your 1040. The first 10% is not deductible. So for someone who earns, after we did all our tax ideas and reduced taxable income and we got you down to make a rounded number of $100,000 of AGI, the first $10,000 of medical expenses are not deductible. So that means if someone's average expenses that are out of pocket is $7,500 a year, they're not, with braces, glasses, and other stuff that's not covered on medical plans, then they'll never get a tax benefit of the money they're spending on medical expenses. But if you have towards the end of the year, you pay for services or you actually use medical services during 2015, a little bit stuff that you really would do in 2016, you can be above the $10,000 limit in our example and actually get a tax benefit from your expenses. So maybe if every January is when you buy the new eyeglasses, so you bought eyeglasses in January, don't wait till January, beginning of the year, buy the new glasses in December, so that your 2015 expenses go up. It may be, pay in full for the braces instead of paying over a 2-3 year payment plan. You pay in full during 2015, so on and so forth. If you have expenses, instead of spreading them out, you try to bunch them into one tax year. I mean, it's not tax efficient to actually, have put all your kids, put all the children into, have, go to the dentist and have all the kids put into braces if they don't need them. But instead of spreading out when you get the braces, you try to do them. You try to do more than one in the same year. You can get an actual tax benefit from the itemized deductions because you're spending more than 10% of that AGI number in 1 year.
Perfect.
And again, if you don't have the money to pay for it, you can charge a credit card.
Cool.
Okay, this is the complete, from a finance perspective, this is complete the opposite of what a finance person will tell you. And to go on further, itemize the charitable donations.
Okay, I think this is the fun part.
Here's the fun part. The fun part is, let's just introduce a new concept. We all have, most of us have our own ideas of how to give tzedakah. Tzedakah, call it what you want, and that is very fine, and that is not what we're so much going to discuss now, because not everything that is tzedakah from our personal perspective will be a charitable deduction for your tax return. So first, you have to itemize on your tax return. Second, and also, for example, you can never give donations to an individual. You can never give donations to an organization with a requirement that they pass on the money to an individual. That's called direct giving. So what we have to do is learn how to give tzedakah in a way that we also get a charitable donation, and also be able to take the deduction. So you get a proper receipt, proper acknowledgement. So here are some tips on how to properly take advantage of the tax deduction for a mitzvah that we're already doing. Okay, so the easiest part is you have whatever budget or whatever your commitments are to give charity, and you've probably done that all year, is using cash, check, or credit card. and that keeps on showing up on some of our slides, the word credit card, to actually give donations to the local tax-exempt organizations that you sponsor, shuls, yeshivas, and other nonprofits. In addition to that, there's other charity and there's other donations you can make. And one of the things which save us money is if you have appreciated property, and what we call appreciated property as accountants, we mean something that you own that if you were to sell it, you would have to look from capital gain. To give you an example, if you bought corporate stock for $1 and it's now worth $100, if you were to sell that stock because you hold it for more than a year, you have $99 of capital gain. If you want to give $100 to charity, you can contribute the stock to charity, directly to charity, and you have $100 of deduction, and you do not have to pick up any of the capital gain on your income tax return. So you're saving taxes twice. Because otherwise, if the IRS would not have this rule, you'd end up either having to write out a check from your bank account or have to sell the stock, pay tax on it, and have $80 or less left in the bank to be able to give to charity. So if you have real estate, stocks, or that's for the most part the most popular assets that we call appreciated long-term capital gain property, and you contribute that to charity, you get a fair market value of deduction. And that saves you a lot of tax. There are a lot of rules and exceptions and requirements, and please refer to the first bullet point, which was to call your accountant for the exact details. Another place that we see where people spend on charity, on tzedakah, and are probably not getting a deduction is volunteer expenses. Volunteer expenses means that if I volunteer my time for an organization, while my time may be valuable, I don't get a deduction for my time. But either my expenses that I spend or some other rate, which I'll explain in a minute, is allowed to be used as a deduction. So if I volunteer for Hatzalah, and I know that I have a clear record of all the gas and toll money I spent for my volunteer calls, I can, with the proper receipt from the organization, I can get a deduction for charity. While that's also good, there's another way to also benefit if I don't have all the detailed expenses of what I spent each time I made on solo call. If I know how many miles I drove for them drove for the volunteer organization during the year, I can deduct 14 cents per mile. Now, while 14 cents per mile may not look like a lot of money, it still is. It's two things. First of all, it's a deduction you're entitled to. And second, depending on how many miles you drive for volunteer purposes, that money can add up. And this is something that you can still do this year because you can based on how you responded to calls, various organizations are pretty good at keeping track and record of who's doing what, when, and where. And they should still be able to give you be able to help you with producing a detailed list of how many calls, runs, or jobs you did for that.
So Yosef, on this particular bullet point, I think this is probably something that a lot of people don't even know this exists. Is this, at the end of the day, is it only the mileage? Because you mentioned gas tolls, meaning to say,
right.
And is this something that the volunteer work needs to be with a car, or if you need to, let's say you volunteer in a hospital, which is a 20-minute drive, or cross the bridge type of volunteer, could you physically document every single trip you did to get to that station to volunteer?
Yes, the answer is yes. But to be fair, I sort of modified my suggestions for things that are at least practical to implement by the end of the year. If you were telling me that you want to track, or all your expenses, it's probably a lot easier if I told you January 1st to start keeping track of every pull you made and every time you filled up on gas, if you made a longer drive, and every time, on your easy pass, every time you pass the bridge, and you could deduct actual expenses. There's a lot more record keeping involved. You would have to track your actual expenses. Maybe you did an overnight trip and you had to stop in a motel. Okay, let's just take an example. If you did a drive to drive someone for an organization to volunteer to drive to Philadelphia or Boston or somewhere to a doctor's appointment, to a hospital, and back. So now you have gas, you have tolls, you stopped for a kosher meal, you stopped in a motel to sleep. There are additional expenses that you can deduct as a charitable donation, but there's a lot more paperwork involved and documenting. And when I prepared these slides, I was concerned that it's a little bit more difficult to do that at the end, for the whole year.
Okay, so let's move on. Let's move on to whom to donate. I think that's an important part.
To whom to donate, and the IRS has created a set of rules, because before we said what I'm going to donate, to whom I can donate also is how much can I get a deduction during the year. So to take one example, if I earn $100,000 this year and I contribute $100,000 to charity, my taxable income is not zero. My taxable income is not zero. The IRS has a complicated schedule that they use to figure out how much you can give income. But the summary calculation is that if I give cash, checks or credit card, or publicly traded stock to a public charity, I can give up to 50% of my what we called before AGI to charity and still get a deduction this year. Any extra money that's not used as a deduction is carried forward for 5 years. If I give other types of appreciated property to public charity, I only can use that for up to 30% of AGI. And there are a couple other exceptions also. So for example, if we're going to give money to a private foundation, then even giving a check is only 30% of my AGI. So when does this make a difference? If I'm giving larger amounts of charity compared to my total taxable income. If my goal is to give 10 or 20% of my taxable income to charity in any one single year, it's not the charity I give to, the type of charity is not going to make a difference. But what we find from a practical perspective, what does make a difference is that if you're doing your year-end tax plan, you find that for tax purposes, you earned more money than you expected from a budgeting perspective. And now at the end of the tax year, you want to maximize your tax deduction for charity, but you may or may not have decided who should get that money. So for example, as part of all this planning or ideas that you come up with, you figure out with your accountant that this year I need to give between now and year end another $100,000 to charity. So the simple solution would be is you write out a $100,000 check to your favorite charity. That is not always practical. So there are other solutions in order to be able to get a tax deduction in this year. You still have time to decide who gets the $100,000, whether as one lump sum or as multiple smaller amounts of money. There are two popular options. One option is what's called the donor advised fund. This is a type of public charity that has a government recognized donor advised fund division, where you give the charity you give the check to the donor advised fund, and under tax law it's treated as a donation today. You still have the right to advise this charity on how they should spend this $100,000. You could decide in January, February, March, you decide next year or at some other further time how that money should be spent. And the way you do that is by advising the charity that you gave the money in December of 2015 how to spend the money. Because of the way the tax law is set up, you get the receipt in 2015, you get the deduction in 2015, and you have time to make a decision at a later point in time.
Mm-hmm. I think another good advantage of donor advised funds is for those people that we need to have each organization needs to be a 501c3 approved, recognized organization. So a lot of organizations, a lot of people that you want to help might not be in that category. So if you give it to a donor advised fund, you usually are able to do certain things where you could advise them as well which charities you want they should give the funds, correct?
Well, what would happen is I'd like to reword what you said, Matt.
Sure.
What is one of the responsibilities of a taxpayer when you're giving charity is to make sure that you give it to an approved charity, like you said. You get a receipt, an acknowledgement in time, and so on. Some organizations are better at this, and some are not as good as they can be. By giving the money to the donor advised fund, you get one receipt for that $100,000, and your deduction and everything is documented. And at a later point in time, in other words, now the deadline is less than 2 weeks to find the proper organization that sponsors that type of charitable good work that you're looking to sponsor. Next year, when you're going to go sit down and find who you want to sponsor and give the advice, the donor advised fund is set up in such a way they're required to make sure that when they give the money away, that they're giving it to an acceptable charity. So when you sit down and you decide who to sponsor, you're automatically going to have the responsibility. It's going to be shared with the donor advised fund for making sure that end charitable work is the check, the receipt is written out to an organization that can receive the donation. So, for example, if you want to do Feed the Poor, so maybe there are all kinds of ways to find out how to feed the poor. So it may be harder to find who is going to which organization should get your $100,000 between now and the end of the year. But if you have time during 2016 to decide that, all that figuring out if it's a proper organization will happen from the donor advised fund side.
Perfect. Let's move on a little because we are getting a lot of questions for Q&A, so I want to leave some time for the Q&A.
30 seconds on the private foundations. Private foundations are tax-exempt organizations that people set up on their own. It has its own requirements. You file its own tax return. Many times you'll see the so-and-so family foundation. Those are typically private foundations. They file a return every year. You give the money to the private foundation, and every year you give at least 5% of the fair market value of what's in the foundation to charity. Those are also very useful, but they also have responsibilities, filing a return every year, paying 2% tax on the net investment income, and the returns are publicly disclosed. Depending on your specific situation, you should choose what works for you. Retirement accounts. There are different types of plans that work for different kinds of people, and I'm just going to give you some of them that we come across. The easiest plan for any person who earns money is to set up as an IRA account. An IRA account is you can put in $5,500 a year if you're less than 50, and the deadline for setting up and putting the first time setting up the account is April 15 of 2016, and that's when you have to pay the money. And that is probably for most people that's the easiest small amount. If you want to go for saving more money, there are various types of 401k plans. with different deadlines for their setup. I'm going to give one example. If you're self-employed or you're a one employee, you're an entrepreneur, you're a consultant, you're a salesman, you have your own company. If we call it a solo 401k, sometimes it's called a SEP 401k. You set up the plan before year end, and you need to fund the plan. You have to actually pay the money by the time the return is due, your tax return is due with extensions. So you have time to actually make the payment. The action item before year end is setting up the plan, but the payment needs to be made, either by, let's say, April 15 if you don't go on extension. What's the benefit from such a type of plan? That if your compensation for purposes of 401k is at $265,000, you can save $53,000. 20% of that money you can put in the retirement plan, and it reduces your taxable income dollar for dollar. What's the benefit? If you're saving money, this is tax advantage savings. You get a deduction now. The money grows tax-free. And in Yitz Hashem, when you reach retirement age, 65, 75, you can take out the money. That all the money in the account can be taken out, depending on how much money you take out every year, and you're taxed at your ordinary income rate at that point in time.
Correct. So just to reiterate on the retirement accounts is, even if you're young in age, but if you're saving money regardless, you're putting away in different formats money, you should speak to your tax advisor. What are ways that you could put away money where it's 100% tax deductible? Is that the essence of these bullets?
Yes, so this is yes, and there are various other pension plans which either can accomplish the same thing or even with larger savings.
Perfect.
Okay. Again, typically speaking, if you're, depending on which type of pension plan you have to set up the plan before year end, and you have time until the due date of the return to actually fund the plan or write out the check to the pension plan. So that there's a benefit to saving the money. So for example, I don't want to get into more details because that's more of a pension consultant's area of expertise. There are defined benefit plans, defined contribution plans, and so on.
Perfect.
Let's go to the next slide, please. Okay. Once we've done all the different tax planning ideas and we've reduced your tax to as much as we could, we've reduced your ordinary income to be as low as possible, we've reduced your capital gains, we've maximized all your expenses, you've spent all the money on the braces and the medical expenses, and you've already written out the check to charity for the year. You may still find that you owe estimated taxes at the end of the year. So take us to explain what we mean with estimated taxes. The way the federal government and the state, in our case New York State, wants us to pay our taxes is you pay during the year quarterly estimates based on how much you earned that year. And then when you file your tax return, if you still owe money, you pay more. If you owe less money, you can get a refund. So paying your state taxes during the year is an itemized deduction on your federal tax return. Your fourth quarter estimated taxes are due January 15th. So the last thing that we usually do as tax advisors, as part of tax planning, is to suggest that you consider paying your fourth quarter payment 2 weeks early. Instead of paying it January 15th, pay it at the end of December. What do you gain? You would have, if you pay a quarterly estimate, you have your fourth quarter estimate paid during the tax year and get more itemized deduction. So with more itemized deduction, you have to pay less taxes. So then, now the second question, which I'm sure most of you are asking, so why should we not pay the tax early? Because if you have too much itemized deductions, you may find that the IRS wants to tax you what's called AMT, alternative minimum tax. Instead of paying tax on regular taxable income of up to 39%, alternative minimum tax counts your taxes differently and charges you 28%. Now, depending on your specific tax situation, you may find that you're subject to alternative minimum tax. For the most part, that means that the IRS says you have to recalculate your income without certain deductions. Take a little bit less depreciation expense. You do not take state and local tax as an itemized deduction, and other miscellaneous adjustments. Those are typically the two biggest items. And what happens is, if you're going to be if you're going to be subject to alternative minimum tax in 2015, you do not get a benefit of paying your state income tax 2 weeks early. Therefore, after you've done all the tax planning you can, you still may have one more thing that you could benefit from. Pay your taxes earlier than you're supposed to. If you're not going to get a bigger deduction in 2015 for paying your taxes early, then just pay your taxes on time on January 15th.
Mm-hmm. Interesting.
Okay. It's a little more of an advanced idea because we're introducing the concept of two different kinds of taxes on your 1040.
Perfect. Thank you so much, Yosef, for sharing your valuable information with our listeners. We have many questions that came up. We'll try to get to as many as we could. If you are on the phone or watching live and you have any tax questions, feel free to send them. Even we won't get to answer all those questions, but we might do a follow-up as well. As we all know, the topic of taxes is not a very exciting topic, but we all want to know the answers and we want to pay as little as possible. And as Yosef started off with, the first thing on the list is these are all concepts, and it's important that every single person that has a business or files taxes and has a relationship with an accountant make sure to have that conversation one-on-one with those accountants, because they need to get understanding what's going on besides just the transactions that they're seeing in QuickBooks or any other system you're using. It's important they have to know what are you doing with your free time and volunteering and charity and so on and so forth, so they could do the best tax planning for you. So let's get to some questions. Before we start, while I decide which question to start off with, I would want to ask a favor. I'm going to push out a poll on the screen, which this will give us some understanding how relevant this topic was and how we should continue on other topics that we can be doing free webinars. If you could take a moment and just vote one of the three answers, that would be very helpful for us. So we'll leave it up on the screen for a few minutes, and then we'll go to some questions. So Yosef, I think we should be brief on those questions so we'll get as many as possible. And if the question needs a longer answer, just tell us it needs a longer answer, and that the person asking the question will need to advise, speak to his accountant, his or her accountant. So the first question is, you mentioned about cash basis. Is there a legal requirement from the IRS when you need to be a cash basis versus accrual basis?
Yes, depending on which type of business you're in and how much your gross proceeds are per year, there are different standards. If you're a service business, if you're not a service business, if you're an inventory business or a manufacturing business, each one of these categories has a different set of rules. Typically speaking, within the limits of this of the seminar time, it depends on the size, how large your gross receipts are for the year or past several years, and what type of business you're in. And to take just a simplified example, a large manufacturer will always have to be accrual basis.
Cool. Any deduction that you're eligible this year, if you decide not to take the deduction this year and you want to take it next year, is that something that the IRS allows you to do?
To clarify, if you give the charitable contribution this year, then it's a deduction for this year, and you can't just plain report it on next year's tax return.
You can or you can't?
Cannot.
You cannot.
What you would do is, one is either report it on this year's tax return and rely on the carryover rules. What you do is you don't write out the check. Depending on the exact situation, there may be other ways to defer, for example, the charitable contribution. But the short answer is, if you actually give the money this year as a contribution, you're not allowed to just report it on next year's return.
Got it. Just a quick moment on the poll. We have 58 people voted, and there is a couple of you that did not vote. We want to close out the poll, so if you did not vote, please take the moment to vote. It is a tremendous valuable for us, so we could know how to prepare information for future webinars. The next question, actually three people asked along the same lines, so I'll phrase it in my own words, is yeshiva tuition. Which part of yeshiva tuition is tax deductible? Could we use business accounts to pay tuition? Could we pay tuition for our friends' kids and make that tax deductible, and so on and so forth? I guess it's not the first time you're getting asked that question, so just shed some light.
One, tuition is not tax deductible. Two, if you pay tuition directly to the yeshiva for someone else, is the only benefit you get is that it is not treated as a gift to the person. So if I paid my friend's tuition, my friend's children's tuition, if I would give the money to my friend and he would pay the tuition, it would be considered a gift, and more than $14,000 a year could be subject to gift tax. If I pay the yeshiva directly for my friend's medical expenses, it's not considered a gift. But paying money, giving money for tuition is not considered a tax deduction for charity. It's not a charitable tax deduction.
Sure. Another very important, I think, a question that came up that somebody just sent in, which probably people could phrase it also differently. I think we discussed that before the webinar about salespeople. So the question he's asking, if someone gives me a check for a commission with a date in December 15, but I only deposited January 16, can I claim that income in 2016 and not in 2015? Meaning, so what I guess the question is, if when you get a commission check, is it relevant when I deposit it as an income or when the check was written out to?
It's the answer is neither of the two. It's relevant when you receive the check.
Mm-hmm.
The relevant date when the check came to you in the mail.
Mm-hmm.
When did you get the check? That is the date. That is the date that counts when you receive the income.
Is that the reason because that company which gives you the commission will file a 1099 in this year for that income, correct? And has to match up?
That's not the tax reason. That's a practical reason why you want to match. The real reason is because what the IRS calls is constructive receipt doctrine. It means that whenever if you have the check in your hand and it's your income, just because you didn't deposit it in the bank doesn't mean that it's not your income.
Mm-hmm. And another question somebody sent, which to be honest with you, I don't even know what it is, but I guess you do. Could you talk a little bit about charitable lead trusts?
I could, but I think it's scope of our time budget.
Okay, so I guess we'll follow up on that. But in concept, what is that? It's another way of giving charity for just
another more advanced method of giving charity. It's depending on how you use a charitable lead trust, or sometimes called a CLAT, C-L-A-T. It's a way of giving money to a trust. And what you're saying is you're using the trust rules and the charitable rules to give money now to a trust, and there's a certain amount of that money is treated as being given to charity, and whatever money is left over in the trust after the trust runs actually is distributed to usually the children or grandchildren of the person who gave the money to the trust. They work when used properly, and they do it. It's
Uh-huh.
just a
Okay.
little bit more advanced than I expected.
Another question, I think I know the answer, but I'll let you answer the question is, if I donate my time, can I bill my hourly rate for a tax deduction?
No.
Okay, I guess they wanted to hear it from an accountant, CPA.
What you can do is, again, is you document your expenses.
Sure.
Okay? And first, you can't, there's two things. You cannot, under current law, bill for your time. Don't deduct your billing time, in other words, your billable rate for your time. While there has been some talk by some politicians in Congress to pass some modified law to allow that, to encourage people to volunteer, it's not part of the current law. And just also note, you're not picking up that billable time in your income either. But that wasn't the question.
Correct. We have time for another 3 questions, and they're coming in the masses. Quick question: as far as used items, if I donate used items from my house to a shelter or any other organization, could I take that value of those used items and get a receipt for the donation?
Yes, you can get a charitable donation. Typically speaking, you need to contribute household items, that, clothing, pots and pans and chairs and tables and furniture. They must be in good, usable condition.
Okay, and the follow-up question to that just came in, looks like by the same person asking, how do I document charity when I give the merchandise? Do I report the cost of goods or the price I sell it for?
Okay. Okay. The answer is that, one, you're going to want to make sure you get a receipt from the organization for what you contributed. Free shopping bags of clothing or a descriptive, they should be giving you a receipt for the items you contributed. They're not supposed to give you a dollar amount on the receipt. Depending on what you're giving and how much you think it's worth, it is very good, would be a good practice to take some pictures. So almost everybody has a phone that takes pictures today. Take pictures of what you're contributing.
Uh,
Depending on the value, if you're giving more than $500 in value, there's more information you need to disclose on your tax return, this Form 8283, with instructions, and depending on the price of what you're taking as a deduction, you'll need to be able to disclose what you contributed, how much you paid for it when you bought it, how you valued it. Items above a certain value need to be appraised, meaning that if you're, let's say, giving an expensive painting to charity, or real estate, or a car to charity, if it's worth more than a certain amount of money, you're going to actually have to pay for someone to value the goods. And you're going to have to report that on the tax return.
okay, I'll ask you another, similar questions came in. I assume it's also a longer conversation, but in a nutshell, if you want to address it, is life insurance tax deductible?
No.
Under no circumstances, or are there different policies?
Under very limited circumstances. For example, group life insurance that is paid by your employer is the first $50,000 of coverage is tax-free. In other words, when we get into the topic of fringe benefits, what type of items your employer, the boss, can pay for and not have to include it on your paycheck of the employee, there are certain items that are considered non-taxable fringe benefits.
Mm-hmm.
So the first $50,000 of coverage is tax-free. Anything above that needs to be included on your paycheck, so it's no longer, it's not really deductible, especially if you own your own business, because you're not really helped if you have a deduction on the business and you have to include it in your W-2.
Got it. So let's end with the last question, which actually came in now again as well. I think that's an important question. So we discussed a couple of ideas how you could save taxes 2015. Why is it better to push off taxes from 2015 to 2016 if you're expecting to having smashing success in 2016 to have even a better year?
Okay, so first of all, it is possible, depending on your facts, that it is not beneficial to push off income. You may find that based on the different rates you expect to be taxable. Because I said before, we said very shortly, the different tax brackets, it's possible that it's more beneficial for you to increase your income in 2015 because you want less income in 2016. So don't feel lost. You can use the same strategies in the reverse. Just turn around, put a mirror in front of your list. You turn around the ideas. Second, even if you're going to be even though you're going to have a smashing success, there are other nuances. First of all, you get another 12 months to pay your taxes. So if you get another 12 months to pay your taxes, you have use of that tax money. Time value of money also worth something. For those of you who are very good entrepreneurs and business, having access to that tax money, 40% of the tax bill, for another 12 months is worth it. In addition, even if you're in the highest tax bracket, depending on exactly how much money you earn and what itemized deductions you have, there are other tax rules, which is beyond the scope of the discussion, which may further increase your tax bill or reduce your deductions. So even if you're already in the highest tax bracket, earning too much money in 1 year can still have an effect on your tax return.
Mm-hmm. That's great. We are hitting the hour mark. I want to value people's time, and we set out that it's going to be an hour webinar. I really appreciate it, Yosef. I thank you very much for sharing this information. I know myself, I learned a lot, and I see from the polls that many people here enjoyed it and learned a lot. I advise all of you to just take this as concepts and then speak to your own accountants and see what's best for you and all these items that were discussed. For those who want to find out more about Yosef and Roth Company, visit the website at rothcocpa.com. Once again, thank you, Yosef. Thank you, everybody, for joining us for this webinar. We actually, we're not participating to have this large of audience join us for the first webinar. If you did not catch all the details, we will send out the recording for the people that were on the webinar from this webinar, and be sure to look out for future webinars. Once again, you are listening to a LTB webinar. Be sure to look out for upcoming webinars. Until next time, onward and upward. Continuing to have a great day. Thank you, Yosef.
Welcome.
All the best.